Well, it gives me great pleasure now to bring on board the living legend of equity stock market, Dr. Mark Mobius. Mark needs no introduction whatsoever. He's the man who coined the word emerging markets. He has called many bull and bear market cycles right. He's a great investor, a very dear friend, and a phenomenal human being. I always look forward to our interactions both personally and professionally. Mark, fantastic to connect with you. Hope all's well at your end and you are keeping safe, and your colleagues and your family members, all of them are fine.
Introduction. Yeah, everything is fine. As you know, I'm speaking to you from Munich, and I'll be leaving for London this afternoon. So I've been doing a lot of traveling around Europe because I can't get back to Singapore yet. So I'm getting a chance to see more of Europe.
So Mark, how is economic activity? You've been, like you said, you've traveled Europe. Last time when we spoke to you, you were in Munich and you're back to Germany after a so-called trip to Italy and to Portugal. How is economic activity in that part of the world? As an observer and as an investor, what's your first take on that?
Of course, the economic activity is down, and I would say it's probably about half of what it would normally be. So, for example, I was recently in Portugal. I was in Lisbon and in the Algarve, and the hotels were about 70%, 50 to 70% full. Of course, Portugal is suffering because of the tourist demand is down, but I would say that's the general trend. I was in Venice as well. There, things were a little slower. I could say about 50% of what they normally would be. But there are a number of people that are traveling to these countries, so it's not as bad as a complete shutdown. Let's put it that way.
Mark, last time when we spoke to you, you were cautiously bullish. But I'm sure the market rally, the comeback in all asset classes, especially equities at large, must have pleasantly surprised you?
Not really, because we knew that this avalanche of money that was being printed by central banks around the world was going to have an impact. So that's the reason, as you know, why I've been so bullish on gold, and I've been generally bullish on stocks because money keeps on pouring in to the markets, and it has to go somewhere. A lot of people are at home gaming the markets, as you know. Companies like Robinhood in the U.S. have had a tremendous following, and that pushes a lot of these stocks up quite dramatically. As you know, some of the internet type stocks, some of the concept stocks that are going up like crazy without really any earnings are a sign of this situation.
Mark, when you look at the kind of frenzy we've seen in a stock like Tesla, or the fact that today's Apple's market cap stands at $2 trillion, which is more than the combined GDP of half of the world. Don't you get worried? Don't you think this is
of course,
euphoria?
I worry that
this is the way the new normal has been set.
Yeah, I worry because valuations, of course, are out the window. I mean, price earnings ratio don't mean anything anymore. Of course, this has been a situation for some time now, which is why the emphasis these days has been more on return on equity, return on capital employed, margins, that sort of thing. But when it gets to price earnings or some of the other traditional valuations, it's out the window. And of course, with Tesla, it's pure speculation more than anything else. And it's quite amazing when you think about it. Of course, now some of these stocks are being split. That adds extra volatility. With a smaller share price, more and more people can get involved. So you have a self-feeding kind of frenzy that's taking place.
So Mark, what's been the nature of your activity? When I spoke to you last, it was early May, and you said, look, you were deploying capital, you were putting money to work. From May and now, which is August and September beginning, have you used the cash you've been sitting on, or are you right now booking profits?
No, we're using the cash and we're looking for new opportunities, new bargains. We've had more cash come into the funds, and we're not going to rush in and just buy anything willy-nilly. We're very careful. So generally speaking, we have about 10% in cash, and we're putting that to work. The interesting thing about our portfolio is that India now has become the largest. And I think a lot of that is not only because of our buying, but more importantly, the Indian market has performed so well that the stocks we have in India have done exceptionally well.
Mark, you had 3 stocks or 3 investments in India. Have you made it 2 or have you made it 5?
It's still 3, but their price has moved up very nicely. So we're still in that position.
Mark, a lot of parallels are being drawn that the current market, what we have in US tech stocks or the FANG stocks, is quite similar to what we saw in 99-2000. What is your sense?
Oh, definitely. When you look at Tesla and some of these other concept stocks, there's no question we're in that direction and in that kind of environment, maybe even more so because back in 2000, we had the dotcom boom. The amount of money available in the market was not as great as what we have now. So there's no question that we, in many cases, we are in that kind of environment. But then there are others, other investors like ourselves are more grounded. We're more cautious about buying these kinds of concept stocks without earnings. So I think you have a sort of a 2-tier market now where you have the speculators going after Tesla and stocks like that, and then the others who are more traditional investors looking at earnings and looking at a longer term trajectory for these companies.
So Mark, if you feel there is a froth in the market and if you feel that stocks like Tesla are simply running because of liquidity and not because of real fundamentals, should one now approach the market with some caution? And is it time now to raise 10-15% cash in your portfolio?
I would say that the lesson that we've learned over the years is that the best time to invest is when you have money. By that, we mean you really have to be fully invested as much as possible if you can find the bargains that you're looking for and not worry about having a lot of cash. As I said, we have about 10% in cash, mainly because we're very cautious about what we're buying and also because of money coming into the funds. But I would say it's probably bad advice to tell people, oh, you better raise cash and do some market timing, because we know that market timing really over the long term does not work. However, what you should be doing is buying stocks that have good earnings, good dividends, a high return on capital employed. Those are the kinds of stocks that you should be focusing on. Of course, most importantly, stocks that have good corporate governance. And you can buy these stocks regardless of what the nature of the market is. The market can be shooting up, it can be coming down. It doesn't make any difference. Over the long term, you should do very well. So given the incredible amount of money that's sloshing around in these markets, it's probably not a good idea to stay away, but to buy those good stocks and ride them up, because there will be money coming into those fundamentally sound stocks.
Mark, is there some degree of complacency in the market now? Everybody thinks that central banks will print money. The second wave, if it comes back, it will not be as strong as the first one. And everyone, in a sense, is convinced that before the year end, a medical company or a few medical companies will magically discover vaccines. So do you think there is some degree of complacency which has got built in purely because of the recent run-up, at least in financial markets?
Oh, there's no question. There's a lot of complacency, particularly when stocks are being bought willy-nilly, regardless of dividends or regardless of earnings. So yes, I would say There's some degree of complacency. And of course, a lot of people expect this money printing to go on and on and on. And eventually it will stop. And when that happens, then people are going to have to run for cover. But as I said, if you're sitting on sound stocks, you should still do quite well, despite what's happening with the money printing as we go forward.
Mark, we are staring at a market where it's a rising tide phenomenon which clearly is at play, which is one end platform companies, technology companies, companies like Tesla which are going higher. On the other hand, you've got a good comeback in steel, cement, metals and some of the value stocks. Which way are you leaning, Mark? The darlings of the market or the underdogs or the ugly ducklings of the market? Are you going towards value or are you migrating towards concept, popularity and growth?
Of course, we're always looking at value, but what we do is look at the overall market trends, where the demands are going to be. And one of those major trends, of course, is electronics. What's happening in the semiconductor industry, for example. The demand for semiconductors continues to rise, particularly now with cloud computing and all the rest of the innovations that are taking place. So what we do is say, okay, semiconductors are moving up, demand is going to be increasing, new technology is coming in. We've got to get on the ground floor in terms of the infrastructure of that industry. So, for example, we're buying in Taiwan so-called fabless companies that design the chips and do the software for the chip industry, for the semiconductor industry. Because these companies are going to continue to have demand for their services and their products. So now this is a long-term orientation that we have. In other words, this infrastructure is going to be in demand regardless of what happens. And we want to be, of course, in that area. The same thing is true in the medical area, medical supplies, technology in the medical area, for example, bedside technology where the instrumentation comes to the person's bedside rather than being in a lab. That sort of thing is the kind of new technology that's coming in and will be in demand regardless of what happens.
Mark, one linchpin for the strength in emerging market has been dollar weakness. Do you think there is too much of bearishness in and around dollar? Do you think dollar index may not remain as weak as what everybody is projecting that it is going to be next coming ways? Because frankly, 9 out of 10, if I can 9 out of 10, 10 out of 10 brokerages and economists I've spoken to, they are of the view that dollar is only going to go one way in next couple of years, which is down, 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 and if I may add, down.
Well, as you can see, the dollar index has really come down quite a lot. And it's down to the level of its lowest trend within the last 20 years, I would say. So we're probably nearing the end of this downturn, but it doesn't mean it's going to go up. In other words, we'll probably see continued dollar weakness. A lot of this depends on what happens with the US election. If Trump wins, then you'll probably see a stronger dollar coming in. If Trump loses, then what we're seeing now is sort of a forecast of Trump's winning or not or losing. I think the trend now seems to suggest that Trump might lose. But if you look at the bookkeepers, you'll see that it's more or less even now between Trump and Biden. So I would say the dollar weakness is really a vote of confidence on the US and particularly on the success of Trump.
Mark, last couple of years have been tough for emerging markets. You understand emerging markets. Do you think now the wheel is going to turn in favor of emerging markets? So one has to choose, you should be overweight and you should be tilted towards EMs rather than, let's say, US equities?
Well, actually, yes, the wheel has turned already. As you know, now emerging markets are neck and neck with the US market. And I believe that some of these emerging markets will do quite well. We've seen with the dollar weakness, of course, currency in emerging markets look a lot better. You can see what's happened to the Indian rupee and other currencies. So on that basis, people are going to get more confident of emerging markets because, as you know, currency is one of the key variables that people look at. With a stronger currency, these emerging markets should do quite well going forward. So yeah, I would say a little overweight in emerging markets makes sense.
Mark, when we spoke last, you were slightly worried about what was happening to China. You were not sure which way Chinese economy would move because of a virus and because of this entire anti-China move which is happening in US and now in India. If China slows down, won't that have an impact on commodities demand? And if that is true, then commodity related sectors, commodity related suppliers, commodity related industries. If China slows down, my question mark is simple. What will happen to commodities and the global demand?
Well, China is slowing down. There's no question about that. And we knew that, in 2010, when China was growing at 10%, it was an incredible phenomenon that we were witnessing. But if you look at the US dollar increase in the size of the economy at that time, and compared to, let's say, 5% or even 4% growth today, the growth today is greater in dollar terms than it was in 2010. And the reason for that is the base of the Chinese economy has grown so much. We're talking about an economy which is much, much larger than what it was in 2010. What does that mean? That means that the demand for everything, whether it be consumer goods, commodities, services in any direction, is much greater today than it was in 2010. So I don't think there's going to be much of a downturn in the demand for commodities, or for that matter, even consumer goods going forward in China. And China is quickly adjusting to the US situation. Exports still go to the US, but have been down, of course, but they're also building other markets, which are very, very important. And growing at a rapid pace. So I don't think this is going to be a big issue going forward. We still think the Chinese economy will grow and will do quite well.
Mark, I don't want to get this one wrong for our viewers, but did I hear you say that in your portfolio, the money which you manage for your clients, your exposure to India is the largest in terms of a country-specific allocation?
Yes, it is. Which, by the way, it really surprised me as well, because if you remember, I think last time we talked, India was third after China, Brazil, and then it was India. Now India is first, which speaks well for India and the tremendous performance we've had.
So which are the three stocks you own, Mark? I'll take my chances with that.
What's that again?
Which are the three stocks you own in India? I'll take my chances with that. I'm sure that our viewers would also like to know.
Well, I don't want to talk about individual stocks because I'm afraid that the people will think that they should be buying them. So I prefer not to. But you can go to the internet and check to Bloomberg what the Indian stocks we hold are. Let me say this. They are focused on the infrastructure area and also in the medical area. We're very interested in the medical sector. So those are the two areas that are very important for us.
Mark, what is your view in general on banks? Because it's not only in India, globally also banks are underperforming. Some feel it's largely because the world may not require that much credit. Some fear that when the economy because the economy is slowing down, a lot of banks will have an NPA problem. And in general, banks have been an overcrowded trade for a lot of investors. Do you think for next couple of years, financials as a category runs the risk of underperforming?
Generally speaking, we have stayed away from banks in all countries. We don't have any bank stocks in our portfolios. And the reason for that is it's very, very difficult to assess the status of the bank loans. How many bad loans does a bank have? What is the status of these loans? So we found that over the years, we're better off staying away from banks unless there's some very, very, very good reason to look at them. But generally speaking, we're finding more bargains in other sectors rather than the banking sector.
Mark, what is the risk to this market? Is it inflation? Is it the second wave of coronavirus? What is the risk?
The risk, of course, is always going to be confidence. In other words, how confident are people about the status of the economy and the status of their future in the economy? That's really the key. And of course, confidence comes from a good government planning, good government execution, and most important of all, the availability of credit. So we're now in a situation where credit is available in spades. There's lots of money looking for a home. So to that extent, we're in very, very good shape. Now, to the extent that that changes, of course, we're in another ball game, but I don't see that changing anytime soon.
Mark, bull markets never die of age. They never die of valuations. They die when the macro changes, when interest rates go higher. So can I safely say that, look, this bull market will continue to thrive and will continue to throb till the time global interest rates don't go down? Because rarely, Mark, bull markets peak out because of P multiples of high price to books.
Yeah, I mean, we're in a situation, as you know, where with interest rates at almost zero in most parts of the world, of course, in emerging markets, interest rates are higher. But even under those conditions, the flow of money is so great that it's looking for a home everywhere, regardless of where you're looking. And for that reason, you can expect these markets to continue moving up. Now, to the degree that governments tighten, central banks tighten, and confidence begins to wane, then you're going to have a problem and the markets will correct. But generally speaking, if you look at the stock markets globally, they do go up long term. And the reason for that is currencies are continuing to be devalued. So it's always a good idea to be into some hard assets, and that includes stocks that have assets and gold and other items that will hold value regardless of what happens to the currency.
Mark, so if someone walks up to you, recognizing you when you're walking in this in the streets in Europe, and he says, "Mark Mobius, I've been a big fan of yours. I've been watching you, and I've been watching your interviews on ET now." And he says, "Mark, give me an advice that how can I get rich?" How would you respond?
Well, first of all, I would say to them, do you like, or I would ask them, do you like what you're doing now? Do you love what your work is? And if the answer is no, first thing I would tell them is change your profession. Because unless you love what you're doing, it'll be very difficult to become rich. Once you find a avocation where you're really very happy, chances are you will do very well and you'll become rich.
And if somebody is rich and wants to remain rich at a time when interest rates are zero by central banks, how can one remain rich or protect their purchasing power?
Again, it's getting hard assets, getting assets, and that means stocks, companies that have assets and have assets that are earning and adjusting to the inflation and to the devaluation of the currency. So that is the only way to remain rich. By the way, that's the reason why many of the big foundations, family offices, etc., come to us and to other fund managers looking for investments in stocks. Now, of course, some people also are in bonds, but I look at bonds as sort of a short-term palliative. The best investment are stocks. And of course, particularly now, with bond rates being so low, you're better off with stocks.
So Mark, while all of us have our experience of how we've dealt with the lockdown and how we've dealt with this pandemic, I'm sure secretly you must be very happy, because when it comes to haircuts, all of us have had trouble in managing haircut. You must be very happy every time that thought occurred.
Yes, that's right. It's very, very easy for me. I can shave in the shower and no problem at all. I haven't been to a barber in a long, long time.
So Mark, I would ask you that what's been your favorite memory of this pandemic? What's that one thing you would like to share with us, not as Mark Mobius, the investor, but as Mark Mobius, the veteran, someone who's traveled the world, who's seen the world, and who has some lovely experiences to share with our viewers every time when we interact with you?
Well, I love travel, as you know. I like to travel. And the reason for that is it's wonderful meeting new people and getting their opinions, their insights. And it could be anyone. It could be someone in a shop or someone in a restaurant or wherever you are. Meeting new people is a wonderful experience. And I would say that to me is the real reason why I love to travel and to move to different parts of the world. You're learning every day when you're traveling.
Well, Mark, it's always a pleasure, and if I may add, rare pleasure to have you on ET Now. Thank you so very much for your time. Thank you for brilliantly articulating your thoughts. And now that you've opened, you've shared with us that your top holding is India, I'm sure for Indian investors that would be very reassuring to hear that Mark Mobius likes India. He loves Indian food. He loves coming to India. And he loves to invest in Indian stocks. So thank you for joining us.
Well, thank you very much. It's a pleasure.